Hello and welcome to the session. Financial Reporting LO2 Evaluate Regulatory Frameworks for Financial Reporting. How do regulatory frameworks shape financial reporting practices? This video delves into the intricacies of regulatory frameworks, both national and international, and their impact on financial reporting. Discover the balance between legal, ethical, and economic objectives in financial reporting. Regulatory frameworks ensure consistent and ethical financial reporting. At a national level, they are shaped by company law and financial regulations. Internationally, they harmonize practices across borders. This harmonization is crucial for global investment attraction. The frameworks protect investors and maintain market confidence. Regulatory frameworks provide the legal structure for financial reporting. Accounting standards offer technical guidance on transaction measurement. Legal constraints are enforceable by law, carrying penalties. Ethical constraints demand fair and transparent reporting. High-performing organizations go beyond compliance for ethical reporting. Equity theory ensures fair treatment of stakeholders. Regulatory frameworks promote equal access to information. Legitimacy theory aligns organizational activities with societal norms. Compliance maintains public trust and legitimacy. Independent verification reduces bias and increases reliability. This is a main call-out for this scene. The International Accounting Standards Board develops IFRS. IFRS provides globally accepted accounting standards. They improve comparability and transparency across countries. IFRS addresses complex business activities and stakeholder expectations. Adoption of IFRS enhances credibility and access to capital markets. IFRS enhances transparency and comparability for investors. It reduces reporting complexity across jurisdictions. Consistent standards improve accountability and reduce misrepresentation. IFRS supports informed decision-making and risk assessment. It bridges the information gap between capital suppliers and providers. National frameworks reflect domestic priorities and regulations. They offer flexibility but limit comparability for international investors. IFRS provides a global framework for consistent reporting. It improves transparency and reduces capital costs. However, IFRS requires professional judgment, leading to inconsistent application. Legal systems, economic development, and cultural factors influence reporting. Common law focuses on investor protection, while code law prioritizes creditor protection. IFRS adoption varies across countries. Strong enforcement leads to consistent reporting. Inconsistent application undermines IFRS benefits. Regulatory frameworks ensure consistent and reliable financial reporting. They protect stakeholders by setting rules and standards. Compliance reduces financial misstatement risk. Independent audits enhance credibility. Frameworks promote transparency and comparability for investors. Frameworks promote accountability and governance within organizations. They ensure management is accountable for performance. Frameworks reduce information asymmetry between organizations and capital providers. They build confidence in financial information. Frameworks contribute to sustainable organizational performance. IFRS improves comparability and transparency across countries. It enhances access to international capital markets. IFRS reduces reporting complexity for multinational organizations. It increases stakeholder confidence and supports informed decision-making. However, IFRS may not align with domestic legal systems. IFRS may not align with domestic tax regulations. Compliance costs can increase for organizations. Professional judgment in IFRS leads to inconsistent application. National frameworks provide more detailed guidance. They reduce ambiguity and improve consistency in certain jurisdictions. Regulatory frameworks impact organizational objectives and strategies. They enhance credibility and stakeholder trust. Compliance supports access to capital and long-term growth. However, frameworks can constrain flexibility and increase complexity. Organizations must balance compliance with strategic priorities. The impact of frameworks varies with enforcement strength. Strong enforcement improves reporting quality and competition. Weak enforcement leads to box-ticking compliance. Frameworks influence performance measurement and risk management. Successful organizations integrate regulatory reporting with strategic measures. Frameworks affect market entry and strategic positioning. IFRS facilitates cross-border operations and partnerships. Consistent application and enforcement enhance strategic value. Inconsistent application reduces IFRS benefits. Organizations must consider reporting regimes in international markets. Organizations must respond strategically to regulatory frameworks. Compliance alone is insufficient for sustainable performance. Strategic planning should embed regulatory awareness. Governance structures should strengthen accountability. Professional competence and ethical judgment are crucial for effective response. Effective response requires strong governance structures. Boards and audit committees should oversee compliance. Strong governance reduces risk and enhances trust. It reassures stakeholders of regulatory responsibility. Consistent interpretation and application are vital for credibility. Organizations should invest in professional development. Technical expertise must be paired with ethical judgment. This ensures financial reporting reflects economic reality. Investment improves quality and credibility of information. It benefits stakeholders in complex regulatory environments. Transparent communication with stakeholders is essential. Clear explanation of financial results reduces uncertainty. It supports informed decision-making and confidence. Open engagement with regulators reduces enforcement risk. Constructive relationships facilitate regulatory compliance. Regulatory reporting should be complemented with other disclosures. Management commentary and sustainability reporting add value. They provide a fuller understanding of performance. This approach is crucial in complex environments. It aligns with strategic performance and long-term value creation. Technology can manage regulatory complexity efficiently. Integrated systems improve accuracy and timeliness. Automation reduces compliance costs and enhances reliability. It benefits organizations and stakeholders in complex environments. Technology supports consistent and responsive financial reporting. In conclusion, regulatory frameworks play a vital role in ensuring the quality, consistency, and reliability of financial reporting. By establishing accounting standards, legal requirements, and ethical guidelines, these frameworks promote transparency and comparability of financial information across organizations. Evaluating regulatory frameworks highlights their importance in protecting stakeholder interests, enhancing accountability, and reducing the risk of financial misstatement or fraud. Strong and well-enforced regulations support high standards of financial reporting and contribute to confidence in organizational financial performance. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07484361688.